Hi, welcome to the channel. So today we have a very interesting lecture about computational finance. So I cover a bunch of topics that are listed here. So downloading some data, computing returns, correlations, cumulative returns, risk analysis, risk and return analysis. Then we'll do some plots, plot the drawdown and the risk and return of each stock. Try to watch until the end. I think it starts with simple stuff, but it gets better as we go through all the topics. And at the end, I think we get to this point where you can get an intuition of what kind of return and risk will give you, and you have to decide on your own if you want to invest in them or not. Okay, so let's get started. So here I'm just importing some libraries that we'll be using. So to download data, I use this function yf.download. Basically, I just pass in a string with the tickers. I just ask for all the data, so the maximum data that is available. This is for daily data, so 1 day. So we will ignore the time zone for now and use auto adjust equals true. That what this does is it just adjust all the fields in the data, the maximum, minimum, close price. Here I have all the data, so it starts from 1980, which I think, Apple's was started trading. We'll have to filter this data, so all the other stocks have some data. So here I'm just copying the close field, so we can take a look at what DF is. So DF has, for each stock, it has the close price, but this is actually the adjusted close price. So what we need is to see in which date the data starts, right, for all the stocks. And we find that by passing this condition, we find the first date that we have data available. So this is at the end of May 2006. So what I would like to do is start working on a date that's close to this one. Basically, what I'm doing here is filtering the data, so it starts on June of 2006. And we can see that we have complete data set, so there are no missing values, right? So then the first thing we can do is compute the daily returns. So here I'm doing it I think it's the most intuitive way to do it. These are actually simple daily returns. So you can compute them using the log of the current price divided the previous price. Those are called log continuously compounded returns. It's a little bit different to work with that data. I think this one is simpler, but you can do it with both. It doesn't change that much. This is one of the kind of magical things of Pandas, that you can just call this function on all the data frame and it computes it on all the columns. So basically what we're doing here is computing this value divided by this one minus 1. So the percent change compared to the previous column. So this is what we call in finance simple daily returns. I'm just going to fill the first value with a 0, so we have a little bit cleaner result. You could leave it out also, but just so this looks a little bit cleaner. And so basically this is daily data, right? Have one observation for each date, but as we saw in the previous video, daily data is very noisy, so it's easier to work with monthly data. So here I wrote down some context of the data that we'll be working with. So these three are ETFs. So SPY is stock ETF of the S&P 500. QQQ is a stock ETF of the NASDAQ 100. So these are stocks. So this has 500 stocks. This has 100 stocks. So basically, if you don't know anything about investing, if you buy these assets, you'll do very well. So I mean, it's actually very hard to beat. A lot of fund managers try and fail. And TLT is an ETF of long-term bonds, US bonds. So it's kind of a safe asset that when there's a crisis, people buy it. In theory, no, it doesn't always happen. So we have these three that are what I'm calling benchmarks now, and then we have these stocks. So these are very popular stocks: Apple, Adobe, Amazon, Google, MasterCard, Microsoft, Netflix, and Nvidia. So I try to pick a little bit of everything. So companies that everybody knows, but they make the analysis interesting. So I'm just creating a list. I'll use it later on. So then what I'm doing is computing the monthly returns. So this is the same code I used in the previous video. So I just convert the index to a datetime object. Here I'm resampling at the monthly level, and then I'm computing this with the information that's the daily data. I'm computing this 1 plus x times prod. So what this does, it aggregates the data at the monthly level. So so now we have one observation for each month. So the date is the last date of the month. And yeah, these, if you take a mean of these, it's a lot more interesting than working with the daily returns. Generally, in the research literature, monthly returns are used. Okay, one very simple analysis that we can do is just compute the correlation matrix. So I have these monthly returns data frame, and I'm just computing the correlation. And what the information it gives me is when Apple goes up, it seems that Adobe goes up or they move together. So the correlation gives me more or less an idea of how together the stocks move. So a high correlation is actually not great because you are not diversifying much. So a low correlation is good because you can reduce the risk. The thing that stands out here is the TLT. So as this is a different asset type, the correlation is not positive as with the stocks. So for example, if I take the SPY, so for example, it's very correlated to QQQ. So these are they have some stocks in common, so it makes sense. But it's negatively correlated with TLT. So that means that when stocks go up, the bonds go down. So, and that's what you would expect based on what happened in history. In the recent crisis, it didn't happen that much. So you have to be careful how much you bet on these relations. Another thing you can do is select a period such as the global recession in 2008 and take a look at the correlations there. So I would expect that the correlations between the stocks and TLT would be more negative now. And we can see that here. I mean, it's not valid with all the stocks, but I mean, it happens with Apple. So almost minus 0.1, and this is 0.33. So yeah, there are a lot of ways you can analyze the correlations of returns. So this is just a simple example. Moving forward, so then another way to look at the data is compute the cumulative returns. So let's say you put in $1 in the stocks, in this stock at the start of the period. Okay, how much money do you have at the end? So let's say you invested in Apple. By the end of this, I don't know, long period, you have $79. So that's a lot. So here I have a cumulative return. So let's say you invested $1 in these three assets. And yeah, we can see how this grows, right? If you invest in QQQ, you went from 1 to 8. So that's a lot. TLT, 1 to 2. So you doubled, but not great. And so this is, I think, a very interesting plot. Here you can get a better intuition of what happened in the 2008 crisis. So the stocks went down and the TLT went up for a period of time. So maybe this is the period where the correlations would be negative, But as you can see, it didn't last for a long time. And this is the plot of all the stocks. I mean, the individual stocks, some did very well in this period. But yeah, the difficult part is knowing which stock will do the same thing next. So that's very difficult. So, but yeah, this is another way to look at the data, a little bit more intuitive than the return data. So one question that we can ask here is, okay, how do I know which stock or which ETF to choose to invest? And one way to figure that out is understanding the risk and the return and how they relate. Here I have the monthly returns data frame. Let me show you how that looks like. This is just the percent change in price for this period of time. And if I annualize this, and basically I do 1 plus the return and elevate it by 12, I get the annualized return. So this is kind of like the average that you can expect that these stocks will give you each year. So I mean, Apple 36%. Yeah, that's true. From if you take it into account from the start, that it'll be very difficult that Apple, that's so large, continues growing at that rate. What I would take away from here is mostly these three values, the benchmarks. So the S&P 500, 10.5 per year. That's a lot. That's great. Without you having to do much. QQQ 15.8, also very good. And then TOT, the bonds, 5% more or less. So we can get a sense of what kind of asset or what we can expect from this data. So, and then there's the standard deviation. So basically the way you compute it is compute the standard deviation and then you multiply by the square root of the period that you're working with. So if you just compute the standard deviation, this will be at the monthly level. And in order to make it comparable to this, we need to annualize it also. So basically, this is the way you annualize the standard deviation. And this gives you an idea of the risk of the stock. Yeah, with these two values, you can compute what's called a Sharpe ratio. That's a statistic that, yeah, it's just a ratio of these values, right? So here I show how you can compute that. Here I create the data frame with the returns and the standard deviation. So basically, let's say the risk-free rate is 2%. So let's say the Sharpe ratio is computed with the annualized return minus the risk-free rate divided by standard deviation. This is the Sharpe ratio. So here I'm computing it and I'm also sorting by it. So, and you can see that it shows a very different picture than just looking at the returns. So actually 1.13 is very good. It means that the return is higher than the volatility. 1.13 is very good. And you can see the SPY 0.54, it's worse, but this is also something that we can trust a little bit more in terms of remaining like that into the future. But then you have values such as Netflix, right? That has 50% annualized returns. I mean, that's really difficult I doubt that will continue happening in the future. I think it's good to look at these values and, okay, let's think a little bit what's likely to continue into the future. To me, it's more interesting to look at the benchmark. So the QQQ 0.73, so a little bit more volatility than the S&P 500, 0.18 compared to 0.15, but the return was also a lot higher. So in terms of adjusted return, it's better than the S&P 500. Basically, this is how you can compute the risk and return, and this is the simplest kind of analysis that you can make in terms of choosing in what to invest. Just look at a period of time. We took a very long period, but define a period of time and just compute these metrics, see what they tell you. So a few more statistics that are useful are the drawdown and the max drawdown. I personally like looking at this because it gives me a more intuitive idea of the risk. So this is computed with the cumulative returns. So you basically compute the maximum, the cumulative maximum, and then we do this calculation. So let me show you how this looks, and I think it will be clearer here. So this is the drawdown for the S&P 500, the QQQ, and the bonds, long-term bonds. And we can see here that the drawdown of the stocks was 50% more or less in the financial crisis. So 2020, I think it was like 20% or something. So recently the values were relatively high. So, and what happened here was that the bonds, they had a smaller drawdown, so they went down, but from the maximum value, but 20% more or less. So they did better than stocks. But in this recent sell-off, the stocks, I mean, they went down less than the bonds. So this is kind of interesting, at least to me, because yeah, these relations sometimes hold and sometimes they don't. So this is something that, I mean, makes a lot of sense because the bonds were paying almost no interest rate, and now they're paying a lot more. So this is an interesting result. So the drawdown basically tells you from the highest moment that the stock was or the bond was, how much it went down from that moment. So this means that from the previous high, it went down 20%. So, and then you can do the same for other stocks and ETFs. So here I'm doing it for SPY, Nvidia, Google. And I mean, yeah, you can see that in the 28 sell-off, okay, Google went a little bit down, a little bit more down than the S&P 500, but Nvidia 79%. that's tough. And then we had other situations that, yeah, Nvidia crashed like 50% and recently 62. So, and I think this gives you a lot more information than just, you know, one value. So I think to me it's very useful to look at these charts. It's a pity that they are not available anywhere. You need to download the data and code a little bit. Okay, so one thing that we can do is compute this max drawdown. So basically grab this time series and look for the highest value. So generally it will be around this period. And this gives you an idea of, okay, what's the worst thing that can happen? And basically for Nvidia, it was minus 79%. For the S&P, 50%. So, and the bonds, this one is actually a very recent one. So this was, yeah, probably here. Yeah, 41. So, okay. So I think having this table gives you a lot of information in terms of how to interpret the investment options. Okay, so one more plot that we can do with this data is, let me show you. So here I just remove the index and change the name to ticker. So you see here, before it was in the index, the ticker. And what I'm doing here is doing a scatter plot between the return and the volatility. So basically, you just pass in the data frame, X, Y, and the text. And this shows you, so you have some sort of linear relation here. But I mean, there are some cases that this is 36% and 30 volatility. So nice. So, and then you have, these are kind of the safer stocks, I guess, this one. And these are the ones that are riskier. So if you go on the right side of this plot, you have higher return and higher volatility. But I mean, yeah, when you plot a lot more stocks, you get a cloud. And there are some stocks that they are in this area. So for example, if you, let's say we want to choose between these two stocks, and okay, Microsoft's giving me 21% return with this volatility. So this Adobe is giving me 22%, but the volatility is 29. So already it doesn't make sense to invest in Adobe. I would invest in Microsoft. So, and then the same thing happens with this stock. Plotting this is kind of interesting. It gives you a kind of big picture of what each stock is and which role it plays. Okay, so that's it for today's video. Thanks for watching, and please subscribe and like the video in order to help it rank better. If you have any questions, just write it in the comments and I'll try to answer.